Company or personal property ownership, which is best for investment? In this video, we cover how you should own your investment property. We're going to cover what other investors do, and it seems to be different for cash buyers and mortgage buyers. Then we look at the top 5 reasons why a company purchase should be considered. You can then decide if these reasons apply to you and are strong enough to outweigh the extra costs of setting up and running a company. We also cover 3 common reasons why investors don't use a company. Before we start, please remember to like this video and watch the message at the end from our channel sponsor, findukproperty.com. Now, I've conducted thousands of video meetings with property investors, and one of the most common questions asked is how should the property be owned? Personally, that means the investor alone or jointly with a family member or partner, or with a company where one or more people are shareholders of the company. And as always, the answer depends on the particular circumstances. We can start by looking at what other investors do in general. Now, when buying low-cost property for cash, such as the properties sold by our sponsor, Find UK Property, the percentage splits are as follows. 75% buy under personal names, either alone or jointly, and 25% buy under a company name. However, when clients buy with a mortgage, the figures are reversed and 75% buy under a company name. The company percentages are even higher if clients are buying multiple properties or are building a large property portfolio over time. But majority of cash buyers are still buying under personal names, and this is especially the case if they're using the rental income personally rather than reinvesting into further property purchases. So let's consider the reasons why a company purchase should be considered. The more of these reasons you have, then the more likely you will benefit from company ownership. The 5 main reasons are: if you're a high rate taxpayer, you're buying with a mortgage, you're building a large property portfolio over time, you want limited liability that the company offers, or you want to plan to transfer wealth to future generations and have better control over inheritance tax issues. Let's go through each of these in detail. The first reason for buying under a company name is if you're a high rate taxpayer. Now, in the UK, income below 12,570 means no tax is paid, and between this and 50,270 you pay 20% tax, the basic rate. Above this, you're a high rate taxpayer paying 40%, or additional rate 45% over 125,140 in England. Now, a company normally pays tax at 19% for profits below £50,000 and 25% over £250,000, with an intermediate rate calculated for profits in between these bands. There's no personal allowance with a company. However, with company ownership, the rent belongs to the company and not to you personally as shareholder. Now, rent can be taken out of a company as a dividend or in other ways, but in order to take the rent, there may be extra tax to pay. For example, dividend tax, which means, in fact, there may be no tax saving. But if rent is not going to be taken out and is going to be kept in the company to buy more company properties, then buying under a company name is an advantage for high rate taxpayers. There are 2 common reasons why some high rate taxpayers don't use or set up a company. Now, many high rate taxpayers who are buying 1 or 2 low cost houses with cash to supplement their income right now do not use a company, as there may be no tax savings. And this chart shows how you can end up paying more tax if you are a company, even if you're a high rate taxpayer, because the corporation tax and the dividend tax, when applied one after the other, together are around 47%, which is more than you would normally pay as a high rate taxpayer, which is a rate of 40%. So they buy under their personal name. But with a company, you do have flexibility in that if you need income, you can take back your director's loan, which you made to the company first, and not take out the rent as dividends, and thus you save on the dividend tax. The second reason is that higher rate taxpayers sometimes buy the house under the name of a spouse or a child who is a basic rate or non-taxpayer. For example, if their partner is not working. Now, this reduces the tax paid to 0% or 20%, thus avoiding the need to set up a company for this tax reason. The second reason why company purchases are considered is if you're buying with a mortgage. Now, normally the interest you pay to the bank is a business cost. With a company, all of this is reclaimable as an expense. However, under so-called Section 24 rules, when owning a property personally, the interest cannot be claimed as an expense. So the taxable profit or official income is larger and the tax paid is higher. There is a personal allowance of 20% of the interest to reduce the tax, which cancels this issue for basic rate taxpayers, but higher rate taxpayers are much worse off. So there are two consequences of this. Firstly, higher rate taxpayers lose out, and let me explain this in detail. Let's assume you have net rent of £10,000 and mortgage interest of £8,000. With a company, the £8,000 is an expense and profit is only £2,000, making the tax on the profit payable at 19% or 25%, only £380 to £500, depending on the total company profits. However, with personal ownership, due to this Section 24 rule, the profit is actually £10,000, as the interest cannot be counted as an expense. So the tax for higher rate taxpayers is £4,000, which is reduced to £2,400 due to the 20% personal allowance. You can see that in this case, higher rate taxpayers pay almost 5 to 6 times more tax with personal ownership. Lower rate taxpayers are not affected by this as they are taxed at 20%, and the 20% allowance compensates for this. The benefit is so large that even if you need the rental income right now, it is still better to set up a company when using a buy-to-let mortgage. The second consequence is that with mortgages, even basic rate taxpayers can quickly become higher rate taxpayers as the official income per property is so high. In the above example, in the case of the company, the income was £2,000. With personal purchase, it was £10,000, even though £8,000 of this was paid out as interest. When you add this to your other income, you can see how one or two houses under mortgage may put you into the higher tax bracket as your official income becomes so high. So if you're considering a mortgage, then company ownership would be better, even though the company mortgage interest rates are about 0.5% higher than personal mortgage rates. Another reason for setting up a company is where you are building a large portfolio gradually over time. This is partly because more properties will put you into the higher tax bracket, making you a higher rate taxpayer. This is especially so if you're buying multiple properties with a mortgage, as your net income for tax purposes is higher due to Section 24 law. You quickly become a high rate taxpayer when buying properties with mortgages. Also, as you're using the rent to buy more properties, you don't need to take the money out and thus avoid paying any dividend tax. Now, you pay the 19% corporation tax, but would keep the net rent in the company, perhaps even add to this by giving the company more loan and buy another low-cost property in one step, or by using the two-step process from Find UK Property. That way, you build a property portfolio gradually in a tax-efficient way. Another reason for investors wanting to use a company is to limit their personal liabilities. Although the system used by Find UK Property removes most tenant and property liabilities, even for personal buyers. Some clients still prefer the limited liability offered by a company. The final reason why company purchase is considered is for inheritance planning and passing wealth to the next generation. For example, if a couple have two children and they personally own 8 houses jointly at a value of £600,000 now, in 12 years, these houses may be worth double at around 1.2 million. The inheritance tax allowance may not increase from the current level of £325,000 per person or £650,000 for a couple. Now, if they pass away in 12 years' time, the children inherit the properties and have to pay 40% tax on the £550,000 of the value that is above this inheritance tax threshold. That works out to £220,000 inheritance tax to be paid by the children. Now, there are three ways to avoid this tax, although your accountant may also come up with more complex trust arrangements depending on your circumstances. Firstly, they can own the properties jointly with their children, either as joint owners or each family member can own two houses if there are four of them. So both parents would remain below the inheritance tax threshold even after 12 years. But the problem may be that the parents don't want to give so much control to their children yet. Another way is that they can transfer some properties to their children later, but they need to do this 7 years before they pass away, which is difficult to predict. And there may be some capital gains tax to pay if properties are gifted after they have grown in some value. Or finally, they can set up a simple family investment company by distributing the shares to all family members, including the children. The parents can still have majority control and no inheritance tax is payable, as shown in this example here. However, if they had more properties, for example, 16 houses instead of 8, then the parents' share values will still go over the inheritance tax thresholds in 12 years, and inheritance tax would be payable. Now, they could gift the shares later, but capital gains tax would then be payable. Another way to avoid this, if your assets are going to be very large, is to set up a smart family investment company. This could reduce tax by using two different classes of shares for the parents and for the children. The capital gain only applies to the children's Class B shares or growth shares. So gifting is not needed and it reduces the inheritance taxes as the parents' Class A or freezer shares do not grow in value. All the voting rights and dividend rights are in the parents' Class A shares, so they retain control. I cover this in detail in my other video entitled How to Set Up a Property Investment Company. Now, even if you have some of the above reasons for setting up a company, you have to see if the benefits are significant, as there are costs of setting up and running a company. For a basic company, setup costs may be around £500, and running costs, including company's house filing and tax returns, may also be around £500 per year. If you set up a smart company, the costs can be considerably higher, could be several £1,000s. Now, let's look at the three reasons why investors don't consider buying with a company. Firstly, with a company purchase, 5% stamp duty is payable even on the first property purchase, whereas clients with no properties don't pay this stamp duty. Secondly, as explained before, you could end up paying higher tax if your income is low and you are a non-taxpayer, but you buy with a company. Many buyers who are not resident and are buying cash will fall into this category as they may have no UK income, but still have access to the UK personal allowance of £12,570 per year per person. So buying under company name means they pay more tax. A non-resident couple could thus buy 5 low-cost houses under joint personal names and not pay any income tax if the net rent is below 25,140. Thirdly, as explained before, another reason not to buy under a company name is if you need the income to live off right now. In such a case, a company purchase could result in a similar or higher tax being paid as a company pays 19%, and then you have to pay additional tax in order to use the money personally or take out a dividend. And as I explained before, with a company, you do have flexibility though, in that if you need the income, you take back the loan you made to the company first and not take out the dividend and thus save on the dividend tax. Thus, deciding if you should buy under a company name is a balance. And many of my investor clients decide this after they've had a Zoom meeting with me and discussed all the pros and cons in view of their personal situation, and also discuss this with their accountant. But in summary, consider a company purchase if you're a higher rate UK taxpayer, using a mortgage, are looking to build a large portfolio of properties, and for better inheritance tax planning. But remember, for many investors who are buying 1 or 2 low-cost houses with cash to get passive income right now, personal ownership may still be better. Now, I have another detailed video with the title, How to Set Up a Property Investment Company. And if your property assets are going to be very large, then you may wish to set up a smart company or family investment company that has different category of shares for children and for parents and can reduce inheritance tax. In this video, I explain what that is and its pros and cons. Please watch the message from our sponsor at the end. Thanks for watching. I'm Dr. T, and this is How to Invest in UK Property.